Imagine a simple jungle economy. A monkey buys a banana for exactly one leaf. The transaction is straightforward because the banana has a clear, immediate purpose. The monkey is going to eat it. But one day, rumors spread. Bananas are getting a little harder to find. Suddenly, because they are perceived as slightly rare, they seem a bit more valuable. This triggers a new idea. If a banana might cost 2 leaves tomorrow, a clever monkey should buy extra bananas today, not to eat them, but to sell them to someone else later for a profit. That shift is where this cycle begins. You are buying the fruit for the potential profit it represents, rather than for the nutrition it provides. Word gets out about these early profits, and the jungle enters a boom stage. Monkeys start hoarding piles of fruit. They see their neighbors getting rich and worry that if they don't buy now, they'll be the only ones left behind. This cycle sustains the frenzy. When monkeys buy bananas, the available supply shrinks, which drives the price up. Seeing that price increase convinces even more monkeys to buy, which pushes the price up even further. Soon, the price of a single piece of fruit reaches 50 leaves, a price far higher than what most monkeys actually earn. The original reason for buying the banana has been replaced by a scramble to stay ahead of the rising cost. At this stage, the crowd has forgotten that a banana is food. They are focused on a number that keeps going up, convinced it will stay that way forever. To afford those expensive bananas, monkeys turn to a tool called leverage. This is simply borrowing leaves from a bank to make a much larger investment than you could afford on your own. This chart compares standard and leveraged investing side by side. On the left, if you use 100 of your own leaves to buy a pile of bananas, and the price goes up 10%, you make 10 leaves. If the price drops 10%, you lose 10 leaves. You still have 90 leaves left, so your situation is stable. Now look at the leveraged approach. You only use 10 of your own leaves, and you borrow 90 from the bank to buy that same 100-leaf pile. If the price goes up 10%, your bananas are worth 110. You pay back the bank's 90, and you're left with 20 leaves. You've doubled your original money by using the bank's leaves. This makes the monkeys feel like they've discovered a shortcut to wealth. But the excitement of those amplified gains makes it easy to ignore the danger if the price moves the other way. The danger grows when the entire jungle starts borrowing to buy bananas at the same time. Suddenly, there is a massive amount of borrowed money competing for the same fruit. All this borrowed cash acts like an air pump. It pushes the price of a single banana up to an unbelievable 100 leaves. We call this a bubble. It happens when the price of a common item climbs so high that it has lost all connection to how useful that item actually is. No matter how high the price goes, a banana is still just fruit. It grows on trees, and it won't stay fresh forever. Eventually, the jungle wakes up. Someone realizes they can't eat a 100-leaf banana, and they decide to sell. The price takes a small dip as other monkeys begin to notice. In leverage math, a tiny dip is a disaster. If the price drops 10%, your 100-leaf pile is worth only 90 leaves. You still owe the bank 90 leaves. When the bank takes their money back, your 10 leaves are gone. You are left with nothing. This starts a chain reaction. The banks see the fruit falling and demand their leaves back. Monkeys are forced to sell their bananas all at once. Millions of bananas flood the market. With everyone selling, the price collapses back down to 1 leaf. The monkeys who sold early walk away wealthy. But the ones who borrowed at the top are left with fruit that is worth almost nothing and a mountain of debt. Real breakthroughs, like the discovery of fire or electricity, changed the jungle because they solved actual problems. They made life easier and more productive. Compare that to a hype cycle. Investors might pile money into a smart monkey in a suit, even if he can't actually do the work. If the thing doesn't actually work, the hype price is based on nothing but talk. You can see these moments coming by looking at the behavior of the crowd. When everyone in the jungle is suddenly making easy money without any training or real effort, the balance is off. When you see everyone borrowing from the same bank to buy the same thing while cheering the price going up, the air in the pump is about to run out. Lasting value comes from how useful a thing is, not from how much hype it has. Before you trade your life savings for a banana, remember it was always just meant for